Over 1.7 million homeowners are currently behind on their mortgages, and surprisingly, there's money to be made with this piece of information. If you're curious about how people are taking advantage of these statistics, stay with us. We'll break it down for you. Before we dive into the details, please make sure to like the video and subscribe to our channel for more insights on real estate, housing markets, and everything in between. Now, let's get started. Reviewing foreclosure data is essential. Understanding it in a logical and clear way is just as important. If we look at Black Knight's July report with a rational lens, we can get a better grasp on what's happening. The numbers might seem overwhelming at first, especially with a 321% increase in foreclosure starts. But on the flip side, we also have a 24% decrease month over month. So what's really going on? Let's break it down. To understand the current foreclosure climate, we need to look at a few factors. First, homeowners are sitting on an overwhelming amount of equity. Second, the foreclosure ban caused a significant bottleneck in the process, slowing down the usual flow of foreclosures. Third, lenders are increasingly offering loan modifications, which didn't happen during the 2008 crisis. These three factors are key to understanding what's happening today. Now let's dive into Black Knight's first look at mortgage data for July 2022. The first thing to note is that the national delinquency rate increased in July. This increase was driven by a 4% rise in early-stage delinquencies. However, it's still just 14% higher than the record low set in May of this year. In other words, while delinquencies are rising, they're still historically low. But why are delinquencies increasing? The answer lies in surging equity loan modifications and the foreclosure ban. These are major contributing factors that are keeping the market from spiraling into a crisis like we saw in 2008. To dig deeper, we're also tracking major delinquencies, especially those where homeowners are more than 90 days past due but haven't yet entered foreclosure. Interestingly, this category of delinquencies pulled back in July after worsening for the first time in 22 months in June. So we're seeing some signs of improvement, albeit in a complex and somewhat unpredictable environment. Another noteworthy statistic is the drop in seriously delinquent loans that have been cured or brought back to current status. From March to July, this number dropped significantly, from 104,000 to 58,000. This suggests that the most accessible workouts, like loan modifications or repayment plans, have likely been completed. But what's left are the more difficult cases, and that's where we need to focus our attention. Foreclosure starts retreated by 25% in July, with 17,700 starts, which is 55% below pre-pandemic levels. This number equates to just 3% of loans that are 90 days or more past due. Now let's take a look at the bigger picture. What does all this data mean for the future? Foreclosure starts are clearly rising, but there's a lot of zigzagging in the data. This makes it difficult to predict exactly when the housing market will feel the effects of these foreclosures. The chart from Black Knight's report highlights that foreclosure sales have risen sharply, up 200% year over year, although they remain relatively low compared to pre-pandemic levels. Total foreclosure starts are also up 321% year over year, but when you break down the numbers, the monthly increases are much more modest. For example, the number of delinquent households increased by 32,000 month over month. That's a significant jump, but it's not yet catastrophic. What we do know is that 594,000 households are currently 90 days or more behind on their mortgages, and these homes are next in line for foreclosure. This is the group to watch closely, as they will likely make up the first wave of foreclosures hitting the housing market. Another 728,000 households may be in a similar position, though the numbers aren't as concerning historically. Still, 1.7 million people are late on their mortgages, and that's a number we can't ignore. This increase in delinquencies is important to watch closely. We're seeing a steady rise month over month, which indicates that the number of struggling homeowners isn't going to slow down anytime soon. However, what's worth noting is that loan modifications, the massive equity people have, and the foreclosure moratorium have kept a lot of people from losing their homes. These measures have helped curb the flow of foreclosures into the market, which is why the numbers we're seeing today don't reflect the same level of crisis we had in 2008. But despite all this, we still have to ask ourselves, can American households afford to be homeowners right now? Based on the data, the answer seems to be no. The amount of serious delinquencies is staggering. It's shocking that so many families can't make property payments despite having record-high equity. This tells us that the housing market is in a precarious position. One thing to keep in mind is that loan modifications can be a lifeline for many homeowners. During the 2008 crisis, these didn't exist at the scale they do today. The fact that loan modifications are helping keep people in their homes is a positive sign, but it doesn't necessarily mean we won't see a market crash. As I'll explain, even without a massive foreclosure crisis, there's still a lot of risk in the housing market. Now, let's look at the chart showing total non-current loans. This is a critical indicator to monitor because it shows how many homes are behind on payments. While 1.7 million non-current loans doesn't seem like a huge issue compared to historical levels, it's important to note that the economy is much different now. We're dealing with high inflation, the Federal Reserve's quantitative tightening, and a volatile stock market. These factors are making everything more expensive, and it's unclear how long this can go on before things spiral out of control. Another important point to consider is new construction. Home builders are sitting on a significant supply of unsold homes. During the 2008 crisis, builders had about 12 months of supply on the market. Right now, we're nearing the same level with over 10 months of supply. This is another potential factor that could destabilize the housing market, even without a foreclosure crisis. One thing to understand is that the foreclosure process is long and complicated, so about 500,000 households are seriously delinquent. We may not see a surge in foreclosures hitting the market until 2023. The delay in the foreclosure process means that foreclosures won't have an immediate impact on the market, but they will eventually affect inventory levels. Despite this, many people are still optimistic about the market. Some believe that home prices will continue to fluctuate, much like the stock market, over the next 5 years. Others are waiting for better buying opportunities as they see potential in the long-term growth of the market. For me, I plan on buying in 2023, but it's important to remember that foreclosure properties don't always make sense to purchase right now. To wrap it up, the data is complex and the current housing market is unpredictable, but one thing is clear: foreclosures are on the rise. That will eventually affect the housing market. Whether or not this leads to a crash remains to be seen, but it's important to stay informed and prepared. If you're out there investing in real estate, good luck, and always make sure to carefully evaluate the data before making a decision. Thank you for watching, and if you found this information valuable, don't forget to leave a like and subscribe for more content. See you in the next video.